October 17th, 1973. Arab nations announce an oil embargo against the United States. Within days, crude oil quadruples from $2.90 to almost $12 a barrel. Gas stations across America run dry. Lines stretch for miles. Factories shut down. Inflation tears through the economy like a wildfire nobody can contain. And silver, this quiet, overlooked metal sitting at $1.50 an ounce, begins a climb that won't stop for 7 years. By 1980, it reaches $50. That's not a rally. That's a 3,300% explosion. One of the largest wealth transfers in modern financial history, triggered by a single choke point being shut down. Now open your eyes and look at today. On February 28, 2026, the United States and Israel launched a massive coordinated strike on Iran. Supreme Leader Khamenei is dead. Iran's Revolutionary Guard responded by effectively shutting down the Strait of Hormuz, a 21-mile-wide passage that carries 20% of the world's daily oil supply. Tanker traffic has dropped 70%. Over 150 ships are sitting idle, anchored outside the strait, unable to move. Maersk, the world's largest shipping company, has suspended all crossings until further notice. Oil jumped 13% in a single session. The biggest move in years. Gold just hit an all-time high at $5,400. And silver? Silver is sitting at $87, down from $121 just weeks ago. Here's the question nobody in mainstream financial media is asking right now. Not CNBC, not Bloomberg, not the Wall Street Journal. If the last time a Middle East conflict shut down a critical oil route, silver gained over 3,000%. What happens this time? And more importantly, what happens this time when the starting conditions are dramatically worse? Because in 1973, COMEX vaults were full. Today, they're 64% drained. In 1973, the Federal Reserve could raise interest rates to 20% to fight the inflation that followed. Today, with $38 trillion in national debt, they can't raise rates to 5 without risking a sovereign debt crisis. In 1973, silver was an afterthought. Today, every solar panel, every electric vehicle, every AI data center, every smartphone on Earth depends on it. This is not a prediction. This is a pattern. And the pattern has a name. It's called the oil to silver pipeline. And it just got switched on again. To understand why this time could dwarf 1973, we need to go back to the blueprint, because the architecture of that crisis is almost identical to what's forming right now. In 1971, Richard Nixon severed the dollar's last connection to gold. For the first time in history, the world's reserve currency was backed by nothing but a promise. That decision alone unleashed inflationary forces that would take a decade to contain. But what turned inflation into a full-blown economic emergency was what happened 2 years later in the Middle East. The Yom Kippur War erupted on October 6, 1973. Egypt and Syria attacked Israel. The United States backed Israel with $2.2 billion in emergency aid. In response, the Organization of Arab Petroleum Exporting Countries imposed an embargo. They didn't just cut off America, they cut production across the board. The price of crude didn't just rise, it leaped from $2.90 a barrel to $11.65 in 3 months, 4 times the price, overnight. Now, here's what most people miss about this period. The oil shock wasn't just an energy crisis, it was a monetary crisis in disguise. When oil quadruples, every product that touches transportation, manufacturing, or packaging gets repriced. Food, clothing, housing. The consumer price index surged past 12% by 1974. The dollar's purchasing power was evaporating in real time. And when people feel their currency losing value, when they watch the number on the gas pump climb every single week, they don't sit still. They move into hard assets. Gold went from $35 in 1971 to $850 by 1980. But silver was the real story, because silver was cheap, accessible, and it had a dual identity that gold didn't. It was money and it was industrial. And that dual identity meant that the same inflationary forces pushing investment demand were also colliding with rising industrial costs and supply constraints. Silver moved from $1.50 to $50. And the people who saw it coming, who understood that oil shocks create inflation, inflation destroys confidence in paper currency, and destroyed confidence drives capital into real assets, those people changed their family's financial trajectory for generations. If this pattern is resonating, if you're already connecting 1973 to what you're seeing on your screen today, hit subscribe and the bell. Because what comes next is the part that makes this time potentially far more explosive. Now here's the critical bridge. The 1973 embargo lasted 5 months. 5 months of restricted oil flow was enough to quadruple crude prices and send silver up 3,300% over the following 7 years. But it gets worse, because 1973 wasn't even the big one. The second oil shock came in 1979, triggered by the Iranian Revolution, the fall of the Shah, the exact same country that's at the center of today's crisis. That second shock tripled oil prices again, and it was the accelerant that pushed silver from $15 to its $50 peak. Two oil shocks, both involving Iran and the Middle East, both shattering confidence in the dollar, both sending silver into the stratosphere. The Federal Reserve's only tool to stop it was a man named Paul Volcker, who raised interest rates to 20% by 1981. 20%. That was the price of containing what oil shocks had unleashed. The economy went into a brutal recession. Unemployment hit 10%, but the fever broke. Now ask yourself one question. Could any central banker on earth raise rates to 20% today? With $38 trillion in federal debt, with interest payments already exceeding $1.2 trillion a year, with every major government on the planet leveraged to its eyeballs? The answer is no. And that single fact, that the escape valve that ended the 1970s crisis no longer exists, is what makes this moment fundamentally different from anything in the last 50 years. Let's map the 1973 playbook directly onto today. In 1973, the trigger was the Yom Kippur War and the Arab oil embargo. In 2026, the trigger is the U.S.-Israel strikes on Iran and the effective closure of the Strait of Hormuz. In 1973, oil quadrupled. In 2026, oil has already surged 13% in one session, with analysts at Wood Mackenzie warning it could reach $100 a barrel if the strait stays closed. Goldman Sachs has calculated an $18 per barrel risk premium already baked into the price. And here's the difference that should keep you up tonight. The 1973 embargo was a political decision by Arab nations. It was a lever they chose to pull, and they chose to release it 5 months later. What's happening in 2026 is not a controlled lever. It's a war. Iran is firing missiles at tankers. Drones are hitting commercial ports in Oman. Ships are being attacked in the strait itself. A seafarer has been killed. 3 tankers have been damaged. This isn't an embargo that can be lifted with a handshake at a summit. This is active military conflict in the most important oil choke point on the planet. And it's not just oil. 1/3 of the world's fertilizer trade passes through the Strait of Hormuz. Qatar, one of the largest LNG exporters on Earth, has already halted production after an Iranian attack on its facility at Ras Laffan. Natural gas futures are surging. The entire energy architecture of the global economy is being disrupted simultaneously. Now layer the silver market on top of this. In 1973, when the oil shock hit, COMEX warehouses were full. There was no supply crisis in silver. The rally was driven purely by monetary inflation and investment demand. Today, the silver market has been in a structural supply deficit for 5 consecutive years. The cumulative shortfall has reached 820 million ounces. COMEX registered inventory, the silver that is actually available for delivery, has collapsed 64% from 240 million ounces in 2020 to just 86 million ounces today. And this isn't just a COMEX problem. Shanghai's silver inventory has plunged 43% in just 3 months. The London Bullion Market Association had its stocks overstated by 3,300 tons in 2021. Silver lease rates, which normally sit around 0.5%, exploded to 8% in January. The physical market is screaming that there isn't enough metal. And right now, this month, the March 2026 COMEX delivery cycle has begun. Over 10,000 contracts representing 52 million ounces are standing for delivery against those 86 million ounces of registered inventory. February just set the record for the highest delivery volume in modern COMEX history. January saw deliveries 7 times higher than normal. Traders aren't rolling their contracts forward anymore. They're demanding physical metal. And they're demanding it right now, in the middle of a shooting war that has shut down the world's most critical shipping lane. But this is where it gets truly alarming. The CME, the exchange that runs COMEX, has raised margin requirements to 60%. They've done this repeatedly over the past 2 months. Every time silver approaches $100, they hike margins, trigger forced liquidations, and crash the price. Silver hit $121 in January. Within days, it was smashed down to $78, a 35% crash in a market that was supposed to be in a historic supply crisis. The same playbook was used in 1980 to stop the Hunt brothers. The same playbook was used in 2011. And it's being used again right now. They are crashing the paper price at the exact moment physical demand is at its highest in history. And this time, there's a war providing cover. So let's do the math that no one on financial television is doing for you. In 1973, when the oil crisis began, the gold to silver ratio sat around 40-1, meaning it took 40 ounces of silver to buy 1 ounce of gold. By 1980, as the crisis peaked, that ratio compressed all the way down to 17-1. That compression is what turned silver from a quiet performer into a generational wealth creator. Today, the gold to silver ratio is sitting at approximately 61-1. Gold is at $5,400. If, and I want to be precise with my language here, if the ratio compresses to where it went in 1980 to 17-1, silver would need to reach $317 an ounce. If it compresses even moderately to 30 to 1, silver hits 180. Bank of America's head of metals research, Michael Widmer, has published a target of $309 for 2026, based explicitly on this ratio compression thesis. That's not a fringe blog. That's one of the largest banks on earth making that call. And the ratio argument is only one piece. Let me show you the supply picture that makes this even more severe. China, the world's largest refiner and a major exporter of silver, reclassified silver as a strategic resource on January 1st, 2026. Only 44 companies now have government authorization to export silver. Beijing has effectively put a gate on 60 to 70% of the world's refined silver supply. At the same time, India placed a massive order for 1,000 tons of silver in October 2025 that literally froze the London market. Swiss refiner Metalor, operating in 17 countries, announced it would not re-enter the market until January 2026. So think about this for a moment. In 1973, when silver began its run, the supply chain was intact. Mines were producing, refiners were refining, exchanges had metal, the only driver was monetary, inflation destroying confidence in the dollar. Today, you have that same monetary driver, potentially worse because the Fed can't deploy the Volcker solution, but you also have a supply chain that is fractured at every single point. Mines are producing at the same level because most silver is a byproduct of lead and zinc mining that has not seen investment in years. New mines take 7 to 15 years to develop. COMEX is draining. Shanghai is draining. London is draining. China has locked down exports. And now a war has closed the shipping lane that connects east to west. Here's the question I want you to sit with. And I mean genuinely sit with it, because the answer has real consequences for your financial future. If the 1973 oil shock, with full COMEX vaults, an intact supply chain, and a Federal Reserve willing to inflict 20% interest rates, still produced a 3,300% gain in silver over 7 years. What does the math look like when none of those safety valves exist, when inventory is at historic lows, when the supply chain is fractured by export controls and war, when the central bank is trapped by its own debt? I'm not telling you what to do with that answer. I'm telling you to ask the question. Because nobody in mainstream coverage is asking it for you. Drop your analysis in the comments. I read everyone, and some of the sharpest thinking on this channel comes from this community. Now, one more layer, because this is where it stops being about charts and ratios and starts being about the reality sitting in front of every single person watching this. The Federal Reserve, Koski's probability of cutting rates 3 times this year just collapsed from nearly 50% to 20%. Why? Because the Strait of Hormuz closure is an inflation bomb. Higher oil means higher transportation costs, higher manufacturing costs, higher food prices. The inflation that central banks spent 2 years trying to kill is about to come roaring back, driven by the exact same mechanism that created the 1970s nightmare, an oil shock from the Middle East. Let me bring this full circle. In October 1973, most Americans had no idea what the Strait of Hormuz was. They didn't understand OPEC. They didn't follow the Yom Kippur War. What they understood was that gas was suddenly 4 times more expensive, their grocery bills were climbing every week, and the savings they'd worked for were melting. By the time they realized what was happening, silver had already moved from $1.50 to $5, then to 10, then to 20. The window didn't close all at once. It closed in stages, each one more expensive to enter than the last. We're in the opening stage right now. Silver at $87, down 30% from its January high of $121, with the most explosive combination of supply destruction, monetary instability, and geopolitical crisis that has existed in the precious metals market in half a century. That convergence is not my opinion. It's the arithmetic of COMEX inventory drawdowns, 5 consecutive years of structural deficits, totaling 820 million ounces, Chinese export controls, a shooting war in the Persian Gulf, and a central bank that has run out of room to maneuver. But I want to be honest with you about what I don't know. I don't know how long this war lasts. Trump has projected 1 month. Analysts are skeptical. I don't know whether the Strait of Hormuz becomes permanently restricted or reopens within weeks. I don't know whether the CME deploys another round of margin hikes to smash the price again before it can reach triple digits. What I do know is the structural architecture. And the structural architecture is identical to 1973 with every single variable amplified. The oil route has been shut down. The inflation transmission mechanism is active. The Federal Reserve is cornered between fighting inflation and servicing $38 trillion in debt. The physical silver supply chain is fractured at every node. Mines, refiners, exchanges, and now shipping lanes. And COMEX is entering its biggest delivery month in history with the lowest registered inventory since the exchange began tracking it. In 1973, the people who understood this framework, who saw that oil shocks create inflation, inflation destroys fiat currency confidence, and destroyed confidence drives capital into hard assets. They didn't get lucky. They recognized a pattern that had played out before and was playing out again. They acted while the window was open. Here's what's in your control. Not the war, not the Fed's decisions, not COMEX's margin policies. What's in your control is whether you understand the mechanism, whether you recognize the rhyme when history speaks it, and whether you position yourself before the stages close, not after. In October 1973, silver was $1.50, and nobody was paying attention. Today, silver is $87. It just dropped 35% from its highs. The world's most important oil choke point is closed, and most people are still watching the war coverage instead of reading the COMEX delivery reports. History doesn't repeat, but right now it's not whispering, it's screaming. And the only question that matters is whether you can hear it.